Hello, everyone. My name is Kamal Manocha. I represent PMS AIF World. So another Friday, another webinar, and this is another educative webinar that we have planned today with Axis Alternatives, and we have Mr. Hitesh Zaveri, who heads the alternate space at Axis. So we want to understand from him because he brings with himself more than 25 years of experience, having managed listed equities, and over in the recent past he had privilege of doing some theses, doing some research in a particular sectors, and that kind of has kind of given him a lot of belief in terms of how and where India is headed and where lies the opportunity, and how is this entire structure and domain of investments is kind of evolving. And that is why we kept the topic as new age investing. So obviously we want to not just talk it theoretically, we want to cover a solution in terms of a product, but we do not want to be obviously focusing on that and sounding like we are marketing a product. We are not at all marketing a product. We are trying to learn and trying to ultimately gauge, and based on our own conviction, eventually we would like to take a decision. So it's an, you can say, a review come evaluation come educative session that we have planned with Hitesh. I briefly did tell you that he brings with him 25 years of experience, but he's an MBA in finance and has done multiple courses from Harvard as well as the Wharton School. And obviously, before joining Axis, he has worked for a long tenure with Aditya Birla Mutual Funds, and we remember those days of Aditya Birla Mutual Funds also. I know him, since then, and it is, I would say, a decade old relationship with Axis, with certain people through which we have been able to organize this session. So over to you, Hitesh. Welcome warmly for this session. And while you will be giving your introduction about the particular session, I will upload your PPT, and then in the first half we will discuss about certain data points, kind of building up our thought process, and then we'll take Q&As from the audience.
Sounds good, Kamal. Thanks for this. Good evening, everybody, and thanks for your kind introduction, Kamal. So, Kamal, though it appears from my screen that I should be able to present, I did try uploading again, and let me try that in a minute after a quick word with our participants today. So excited to have this conversation with you all today. Especially about the topic that is kind of dear to me. And the topic broadly, the way I talk about it in recent period, is India of 2020s. India of 2020s is going to be very interesting. It already has been very started on a powerful note, and we had 8.2% GDP growth for the year ended March 22. In the current year, we are talking about very close to 7% of GDP growth. Followed by 6.2, 6.3% GDP growth. I mean, this year we are having second largest GDP growth in the world in G20 after Saudi Arabia. I mean, which without absurd oil prices they wouldn't be there. But a broad-based, large economy, India is actually the largest growth rate now in 23. And then there is something that is forecast by IMF and World Bank and OECD to continue in 24 as well. And the forecast also is, and that part is important, is that India is forecast to be a $5 trillion economy by 2028, again an IMF forecast. However, as Kamal was pointing out, this is the area which is, very wrong thing to stop at the headlines. Headlines are what the headlines are, that India is going to be grow this big. However, idea is to really dig deep and try to understand, at micro level, what is driving this growth, whether this growth is sustainable, whether this growth is value added, whether this growth is widespread, what further implications it's going to have. So that is what our research area has been about. And then what proof are we working with, right? So that is what I'm going to be discussing with you today. Let me try and load a deck here. A brief introduction. Also, I work with Axis Mutual Fund. I run their AIF and PMS funds. Over 2.5 decades in the equity markets, and worked with a few firms that Kamal named. In addition to that, I spent many years in Edelweiss Capital, and then prior to that in something what used to be Apple Mutual Fund. Anybody in the market for a long time would know of it. And a research-based fund management is a passion of mine, uh, and value investing is something that I would like to follow, but with a couple of twists, which is very data driven, very research driven. And then let me open the deck. Uh, can everybody see my slide fully?
No, Hitesh, we can't.
Okay.
Yes, now we can see absolutely.
Okay. And I let me know if I need to do anything for a full screen or something. From my deck,
No, this is
laptop, it
fine.
looks full
This is
screen.
fine. Absolutely, this is fine.
Great. Thank you. Uh, So why are we calling new gen? And please don't take this as any of the fun conversation. It is not. As Kamal again pointed out, this is let us converse like friends today. Let's and with only the researched portion is a topic between us. Let's talk about that. This is a very important and interesting decade for India, India of 2020s. In this decade, in March 22, India crossed 3 trillion of GDP for the first time. In this decade, India is going to cross 4 trillion GDP and again 5 trillion GDP. In fact, in our calculation, India is going to cross 6 trillion GDP either in 2030 or 2031. So in this decade, we are talking about 3, 4, 5, 6 in the same decade, which is extraordinary. Point number one. Point number two, with every additional trillion, of course, in percentage terms, it becomes smaller, but doubling, going from 1 trillion to 2 trillion, of course, 100% growth. And we crossed, since independence for the first time, reached $1 trillion in GDP in 2007. 2016 was 2 trillion, 2022 was 3 trillion. However, again, this is a headline. What is important is that what drove this GDP growth. If you look at recent decade and if you look at the coming decade, then what is driving this growth? What is that, and which part of this is sustainable? What you are seeing on this slide is depicted here in this graph, exactly the same thing. Where you see my cursor, this is when India crossed 1 trillion GDP. 10 years later we crossed 2 trillion, and then relatively shorter span of 6 years we crossed 3, which we already done, and then we are talking about 4 and 5 trillion by calendar 27 or FY 28, as per IMF. IMF has revised downward world GDP growth and India GDP growth, but this number has remained untouched. We are still forecast to go to touch $5 trillion by 27-28. What drove this growth? I remember going to Delhi in 1998 for a NASCOM McKinsey presentation, which was the first NASCOM McKinsey project, where it said that the Indian IT industry, which is $3 billion in revenue at that time, will become $50 billion, 50, in 2008. And at that time, I remember what stir it had created. NASCOM McKinsey report came out again in 2002 when it said that this $11 billion industry will become $60 billion industry in 2010. NASCOM McKinsey report 3 said that the $21 billion industry in 2005 will become $150 billion in 2015. And there were a couple of reports later, and 2015 report says that as versus the actual $145 billion industry in IT, that industry will become between $350 to $400 billion in 25-26. What a phenomenal ride. As you can see, part of that above in the GDP number. Pharma industry from 4 billion has become 10x to 40 billion, and further expected to triple before 2030. Specialty chemicals, India, for those of you who are familiar, and for those of you not, India makes 80,000 different kind of chemicals. Hitherto, we were doing low value added chemicals, bulk chemicals like soda ash and nitric acid and sulfuric acid and stuff like that. For maybe close to 20 years, 15 years, we are making more multi-stage processing, more complex chemistry, more complex specialty chemicals for a variety of world markets. And the industry has become 6x, from close to 30 billion to close to $180 billion, and it's further expected to double. Similar to NASCOM McKinsey, even in pharma and chemicals, again in tier one. So the industry bodies keep on appointing such as Bain, consulting firms such as Bain or E&Y and KPMG, and so on, we have used only those numbers because we have been a bit prospectus minded about our research, that will take only their word for it and their research for it. It was, more like 120 years ago, believe it or not, that early period of 20th century, I'm talking about 1900, 1905, 1910, that for the first time in human history, that a carriage, a vehicle was not driven by an animal, a horse, but an engine, and we had for the first time petrol or diesel engine and mass cars came in 1906 and so on. For the first time for us in our lifetime, we are going to be seeing transition from internal combustion engine, petrol and diesel, or ICE engine, to EVs. And CII has a forecast that as versus automotive contributing to 7% of India's GDP, that it will contribute to 12% of India's GDP, mind you, much larger, on a much larger base. So, and then the all the related industries are included here, which is the electric battery, which is the electrical power points and electrical power points, power trains, and everything gets related to the EV. In two-wheelers, in light commercial vehicles, in three-wheelers, four-wheelers, including to some extent some heavy commercial vehicles, will be EVs in India. Now, all this, if you put together, what common thread do we see? The common thread do we see that the industry that have powered of India's GDP growth from 2000, as we see from the left-hand side, all the way till today, is that our GDP growth has been driven by industries that can operate only on innovation, knowledge, IP, and sciences. This is the common thread, and this is what we wanted to deep dive on. People say that for every mission to succeed, there needs to be a missionary. In India, we have an extraordinary, phenomenal quality of entrepreneurship, as we see it, in terms of how Indian CEOs have become leading global fantastic companies around the world. And the real reason is the quality of entrepreneurship in India. And so the important ingredient that you need, in addition to innovation, IP, and sciences, which may be there, but somebody needs to put all of this together and stitches together and create a large business out of it. And India has that in high quantity, and which is a great blessing for the country. So entrepreneurship is another ingredient. The third important ingredient in making the country successful and economy growing large is the availability of capital, the growth capital that is available. The growth capital, which is made available by rapidly growing private equity and venture capital system, much mature banking system, which is now lending to early stage companies. Every bank that we speak to or that we are invested in, HDFC Bank and ICICI Bank and SBI and everybody, all the top 15 that we end up speaking to, have proper systems to lend to early stage companies. And of course, when it comes to equity, there are Ps and VCs. And before the recent months of funding winter, India was practically creating one unicorn a week in good part of calendar 21 and good part of 2020 as well. And this is again a very powerful ingredient for all-round GDP growth. And lastly, another powerful pillar is also very supportive government. When was the last time that government will give you the data on what is the annual progress of ease of doing business in India? When was the last time that the government would tell you that what is the UPI transaction this month versus the last month? What is the growth? What are the connected numbers of Jan Dhan and rest of the bank accounts that are connected with mobile phone and the Aadhaar identity? Earlier, what used to be a nightmare 10 years ago is become very easy, which is if I give money to you, if I lend money to you, I can recover it back. And that changes everything. If I want to transact with you, if I want to insure you, if I want to have you on my e-commerce platform, suddenly, 1.4, good part of 1.4 billion of us are becoming more and more productive. And therefore, India's growth is really grassroots based, very widespread. And that is the power of the very conducive policy environment that we are witnessing. When you put all these four together, what we are essentially talking about is that there are a number of industries that are going to be big beneficiaries. So what we are looking at is that when India went from 2 trillion from 1 trillion, which are the industries that made it, that powered that growth? When we went from 3 trillion from 2 trillion, which industries powered the growth? So it turns out that the industries that have been doing really well are the ones that will continue to do well when you look at all kind of data with regard to the per capita income growth, per capita disposable income growth, the size of automobile industry in India, the size of the tech industry in India, size of healthcare or chemicals in India, and so on. And of course, substantially fast growing internet e-commerce and the omnichannel retail. What we wanted to do is that use the insight of the numbers of 2 minus 1 trillion and 3 minus 2 trillion, and then use a number top tier 1 quality forecasts about every industry, and then that is step 1. Step 2, in which industries there have been capital market winners, which is the one of the number one in the industry in India in the last 20 years in terms of investment return is actually private sector commercial banking. In terms of what is the market cap of private sector commercial banking, in early 2000s versus today, the number one industry in terms of growth rate is actually private sector commercial banking. For all this time, we would colloquially hear from fund managers on CNBCs and in seminars that we like to invest in banking, IT, pharma, healthcare, internet and autos and things like that. But right here, based on some additional proofs, the only thing that is different is that we have some of the winners have altered. Some of the companies that were newer companies are emerging. Some of the newer industries are emerging, and that is what we are focused on. So when we did a bottoms-up analysis and did all of the 5 forces 101, that which are the industries where from a capital market perspective, that over the next 5 to 7 years, that a lot of winners will emerge in terms of shareholder return. And in our view, a lot of stock market return winners are going to emerge from here. There are many industries. For the sake of argument, airline industry is going to grow really massively in India. For the sake of argument, the retail, the textile sector is growing to textile retailing, textile fashion is going to grow rapidly in India. But why are they not here? Hotel industry is going to grow a lot in India. Construction industry is going to go massive in India. But why are they not here? The reality is that return on invested capital minus cost of capital is not favorable in airline industry. It is not favorable in Indigo, as market share leader as it is, and doing a phenomenal job, especially over the last 10 years. Where are the stock market returns? One of the best rated hotel chain on the planet in the world is Oberoi Hotels, or one of the revered hotel group in India is the Taj Hotels. When you look at on a 10-year basis, 15-year basis, where are the shareholder return? Shoppers Stop is listed for a long time. If you look at 10, 15-year period again, so the point is that the many of the industries, such as airlines, such as retail, such as hotels, and many others, the returns are kind of limited. In fact, we have done some another analysis in the area. When you take all the companies in India and classify them as per the MSCI industry classification, there are 61 industries in India, 61. Out of that, 17 industries, 17, have accounted for 75% instances of stock outperformance in the last 20 years. And the 44 industries have accounted for 25% of the instant outperformance. So industry dynamic matter a lot. It matters very powerfully. It's second most important reason why a stock price will go up. First reason is too simple, so I don't even mention. Why did the stock go up? Because it was too cheap. PE was cheap, PE price to book was cheap, so it went up. I mean, it doesn't take a rocket scientist to answer the question. But the second answer is tricky. Why did the stock price go up? Because there is the alteration in industry dynamic, and when it turns in favor of shareholders, then it becomes very interesting. So industry dynamic can be such they are good for shareholders, or they are neutral for shareholders and customers both, or they are good for customers, the dynamic, and not good for shareholders. The industries which are beneficial for shareholders, that is what we go after, as versus industries that tend to be more beneficial for customers as versus the shareholders. Moving on, Kamal, would you like, should we going into each industry or discuss it, or because
So you can maybe cover this presentation for 10 more minutes and then we'll take Q&As.
right. So, I'll just cover the headline part of it because there are substantial number of slides on the subject and so on. But the bottom line is, as versus what the traditional banking that all of us have been used to, banking is, fundamentally altered and so on. Uh, uh, if you, for example, currently, if you were to look at the the investor presentation of ICICI Bank or Bajaj Finance or Axis Bank, for example, you will find that 10 to 15% slides are actually on technology. They are on about how the mobile app during the last quarter and the last year was made better. What APIs did the bank initiate and build for various industry verticals and so on. Then which fintech did the bank acquire, and so that is what it becomes, very interesting. So banks have been acquiring fintech and taking those abilities. If you notice, none of the fintechs actually, upstage the bank's ability to do something. But the bank which have been more dynamic are the banks that have emerged and come up better. Banks are able to use AI and ML to do better quality underwriting, better customer sourcing. So again, big beneficiary about quality banks being able to use tech. So what we are at, just to go back to the early part of what Kamal had mentioned, what is today's conversation about? Today's conversation is about is that when you look at India's GDP growth from 2 trillion to 3 trillion and 3 trillion to 5 trillion, if you want to have these two broad buckets, and pick out inside of that the common threads, and third, try and isolate which are the industries that are going to be winners. That is what today's conversation is about. Excuse me. Um, so, um, Kamal, this the deck doesn't seem to be visible here. Yeah, thank you. Next to bank, it is tech and tech IT services. Of course, there nothing much needs to be discussed here. The reality is that tech has been the opening best batsman, if you will, in India's remarkable journey from early 90s. Infosys was 1.2 million revenue company when it came for IPO in 92 93, and then there is no looking back since in India. So, and even today, the IT industry is versus $145 billion of 2015, and the current number is around $227 billion at the industry level. We are still forecast to become between 350 to $400 billion by 2025. So, a remarkable growth will continue, and number of players, cloud players, software as a service player, platform as a service players, IT services, which have transformed to become more cloud enablers to Fortune 500. All kind of companies have doing wonderfully from India and present investment universe. Similarly, India's biotech and healthcare, substantially large number of insourcing that is coming in. You essentially buy out a molecule of an innovator, from advanced geography, and create a drug out of it and then market, or use your own R&D, isolate a drug and a molecule and out license if you can, and grow from it, acquisition of companies, growth to development markets, more and more focused on R&D. So this is how Indian healthcare and biotech has transformed. And again, we think that there is going to be healthy growth here as well. Specialty chemicals, we were essentially primitive players if you go back 20 years. Things have substantially changed in the last 20 years. We do a lot more complex, chemistry, benzene based, toluene based, fluorination based, and so on. The reality is that we do be doing 4, 5, 6 stages of chemical processing, a lot more uh, high quality work, and become a global supplier. And that is what become interesting in India, and that is we were rather focused on. high pitch talk, so that is something we are wary of, but then we look out for opportunities here. The smartphones that India is going to have and the 5G network that India is going to have by 24-25 is going to be meaningfully different and better versus today. As it is, we do phenomenally well. The progress that we have made in terms of smartphone penetration and the quality of network. Um, you know, uh, Everybody you will pass by on the street feels free to stream high quality videos, and people are able to spend time, do their e-commerce, book their plane tickets and train tickets, book their movie tickets, play the games, play multiplayer games, and uh, do as you please on mobile phones. And going forward, this is going to get even more ingrained in our mindset. So the companies already, such as Nike and Policy Bazaar, Car Dekho, and everybody else, there is hardly any activity that you can think of that you can't, initiate and make a lot of progress on. All of that can be done on mobile phone right now, and that is phenomenal. We discussed about this briefly. Currently, roughly around 4 to 5% of incremental new registrations in two-wheelers are already on EV. Roughly around 2% of passenger vehicle registrations are on EV, and that is going to improve with every passing year. 2, 3, 4 years from now, these numbers are going to be in double digits and going to be strong. So again, we are positive here, and the whole ecosystem of EV makers, people are going to straddle both automotive and ICE and EV. People who are going to be in auto ancillaries, exciting times. Omni-channel retail, in recent couple of months ago, I was in Singapore. In a regular suburban mall, I saw a Lenskart physical showroom, a company that was supposed to be online, a physical showroom, and that across spreading across Asia, not only India. I was traveling to Gujarat and I saw Make My Trip, a physical store which is online, booking system where people can walk in and do their holiday plans, and vacation planning. And then so a company like Titan, as brick and mortar it basically now reports every quarter that what is their omni-channel retail, how much of stuff got sold through online channels. So omni-channel retail is going to go very powerful. Something like Nika, which was online only, and you go to any prominent place near airports and major malls, you will see a Nika store now. So fantastic change coming there as well. Uh, so, from the investor standpoint, what we are interested in is that when there are upheavals happening because of new technologies, because of consumer behavior changes, new business models are going to come into existence, and that is what is going to create market mispricing, and that is what we are interested in, because there is mispricing, there is in complex events, such situation arises. Such inefficiencies are good for people like us who want to seriously go through companies prospects, their conference call transcripts, uh, do on ground research, speak to their customers, speak to their competition, and then identify some business which will be interesting for us. Kamal, should we be closing with this or any further conversation here? You are not audible, Kamal.
Presentation has been covered. We can move ahead to the Q&A part.
Sure.
So you can switch on your camera, Hitesh.
Sure.
So, the foremost question after seeing a presentation comes to my mind that everybody has been talking about the fact that India's economy within this decade itself has crossed 3.5 trillion. And from here, we'll be, crossing like 5 trillion and then 6 trillion, as you mentioned. Obviously, financial services being the highest composition, highest allocation in Nifty 50, which is around 40%. Nifty 500, which is around, I think, 35%, right? And then followed by that, it is IT, and then other sectors. So, are what are your views, in this regards, in this entire progression from 3.5 trillion to 5 trillion to 6 trillion? Will this allocation change? If it will change, how will this change? Which sectors will become dominant sectors? Like, when US economy grew in last 2 decades, tech has become their largest sector. It
Yes.
used to be financial services at one point of time. used to be oil in at some point of time. So I'm wanting to understand, because we are talking about decade, we're talking about a bigger picture. So it is important to understand your view, because you have worked on this subject. In this regards, like in last 5 years we have seen specialty chemicals as a sector which came up.
Yes.
Now if you talk about investing in specialty chemical sector, it is okay to get some 15, 16, 17% returns. But
Yes.
when the overall elephant is growing, then when the overall economy is growing, the real thing will be, real discovery will be to find out which sectors will generate more possibility of growth, and which sectors will actually increase their contribution towards this growth in the overall market cap to GDP ratio. As GDP will grow, market cap will also grow. So over to you.
Yeah. So Kamal, that's a very good question. Actually, in this part of the crystal ball conversation, my view is that we have actually focused a lot more on the next 5 years in our research, because we are more interested in 3 trillion going to 5 trillion. Therefore, what is going to change? We didn't go out further into the future, looking at 2032 and 2033 10-year research, but something where we can actually have real numbers with real forecast kind of situation. uh, my view is that banking is going to remain top for a few reasons. First, India's nominal GDP growth is going to grow at 12-13% a year, because 6-7% of GDP and another 4 or 5% of inflation, and hopefully not higher. Therefore, the nominal GDP is going to grow by 12-13%. That's basic driver number one. What is incremental is, currently India has around leverage at 57% of GDP, which in advanced countries easily runs at 120, 130%. People, it's very normal for people to take some loan and own asset. People may want to own vehicle, people will want to own homes, people will want to own more than one home as family get bigger and split. People will want to fund their vacation, people will want to fund their lifestyle. There can be a variety of reasons for people who want to fund their small businesses, by the way, in the country like India, where de facto gold loan is a SME funding. I mean, more than 80% of gold loans are actually SME funding. So, so therefore, when there is a secular growth rate in banking of 12-13%, plus the more efficient part of the banking system, the entire funding system. India has thousands of NBFCs, but the more efficient part, which is, we are talking about 10 to 12 private sector banks and, other 10 public sector banks. I think that they are going to grow at 15-16% a year. And with, and there are enough for, so I've seen some numbers where the India's, GDP to leverage ratio is going to be close to 100% versus 57%. That provides 1 or 2% more. In other words, this industry is going to grow at 17-18%. And inside of that, hopefully, private sector bank will continue to do well. So we should be in for a good time, and therefore, I think that to answer your question, inside of Nifty, the benchmark weight will continue to be in favor of banking, despite the fact that IT will do well as well. But the structure of Indian IT, we do IT services. So our businesses are not scalable. We are annual growth rate companies. We are not, software as a service giant, which, for example, Microsoft has become now. Uh, or what Apple has been trying to do. Apple makes a lot more money by selling us storage, by selling us streaming services, by selling us, other services, rather than we buying iPhone alone. It is essentially iTunes where they make a lot of money from in terms of their profitability. So, but in terms of IT services, we are essentially focused on, there is nothing, you deliver a project, you make money for it. The only repetition comes from the repeat client business, which has to be incremental. Having said that, it's going to be a powerful industry because we do really well what we have mastered. Having said, we also have a waterfall situation in India, the IT industry. So we have TCS, then you will have 35-40% smaller Infosys at around 65% of TCS. Then you will have likes of Wipro and HCL Tech and so on and so forth. By the time you reach company number 10 in India in terms of size, it is not even 1/15th of TCS. So therefore, they are not necessarily going to become very large part of Nifty beyond today.
Thank you so much. So another question, which I think is relevant for this bigger picture that we are discussing today is that today, if one talks about, say, Fortune top 100 companies worldwide, I think, first of all, India's contribution is there, but it is low because only Reliance Industries and TCS are the two companies which, are part of top 100 list worldwide. I think US has around 60% in terms of, number of companies in this list, and China has around 15-20% further, and then remaining is spread amongst various other economies. So in this context, over this decade, by end of this decade, when India is, say, at 5 trillion or 5.5, 6 trillion economy, what are the other companies that come to your mind, or maybe any one company that comes to your mind which will belong to this list?
I think it will be more in the banks again, likes of HDFC, now that HDFC is going to become HDFC Limited plus HDFC Bank. So that is another one name comes to mind. ICICI Bank, a name that will come to mind. I also think that, more for all you know, some of the India's green energy companies which are becoming, something from Adani Group can, as from the when we actually become a green giant, green energy place, because people have talked about, close to 20 to 30 billion dollars of investment, which is massive, and then whatever else downstream businesses that can be. Um, Infosys can join the rank after TCS. As it grows at that point in time again. Um, I'm sure I'm missing a few major names there, but I mean, these are the names that kind of straightforward come to my mind. I
Sure.
don't, if you notice, I did not talk about ONGC or Coal India or any of that because these are not acquisitive cross border. The companies in the US have always been very acquisitive cross border when it comes to energy.
Right. Right. Third question that comes to my mind is that during this, progress, another thing which is important as a driver to ensure that India grows to becoming a 5, 6, 7 trillion economy in this decade is the participation from manufacturing side of, I would say, India's uh, pillars. So, India is a populous country, and obviously, manufacturing requires large manpower. And today, because of many orders from China could be coming to India and various reforms that have taken place in this industry, there's a structural economic shift which we see a lot of fund managers confidently talking about. And I also, coming from economics background, see myself that manufacturing is going to contribute a lot. So in this regards, how can this particular area be encashed in terms of opportunities from the perspective of investments? Would you want to cover for
Yeah,
maybe
sure.
next?
So it's a good question. So we made sure that, for example, when we talk about automotive in the seven industries that we covered today, of course, it comes from manufacturing. If I talk about chemicals and specialty chemicals, again, it comes from the manufacturing side and it's kind of covered. We When we talk more of healthcare and biotech, of course, it requires manufacturing. So in reality, it by the way, all the industries IP plus manufacturing, science is knowledge plus manufacturing. So that is what is changing, and that is what I wanted to point out. We have, as in the country, we have really gone gaga about contract manufacturing. In the year 2018, 19, 20, and 21, and the stocks were 40p and 50p and so on. But in last 1 year, we have seen meaningful corrections because if you don't have IP and you become a very large contract manufacturing company, you will because we don't have 50 companies or 20 companies to pick from. We are still talking about 5 or 6 companies in India which are listed and large and you can invest into them, right? So there's some scarcity effect. But when it comes to manufacturing, we the industry that I named are there where we think there is going to be ROIC minus cost of capital in your favor because outsourced, for example, textile manufacturing, let's say for example Gokaldas, I'm just taking an example here, or any of such nature where there's non B2C manufacturing involved. In that, I don't see lot of P multiple reasons for P multiple to be high for a long period of time. As versus that, in come to mobility, when it comes to look at Maruti PE, for example, they have been fairly healthy for a long period of time. Take Mothers and Sumi, very healthy PE for a long period of time, and so on and so forth. And so uh, To conclude it, really, one should look for that what differentiation when it comes to manufacturing. And by the way, inside of automotive, I will also point out in automotive battery manufacturing, the names there in battery manufacturing, they are looking interesting because EV is going to become part of our daily life, and there are going to be a lot more applications outside of automotive alone. For example, already there is conversation that hundreds of thousands of India's telecom towers should have e-batteries, and going away from diesel and all this maintenance situations and so on. So to answer your question, these are the criteria for us is to manufacturing plus IP and sciences.
So, you mentioned this presentation also about EVs.
Yeah,
Obviously, all of us understand the potential of this transformation to EV.
yeah.
And in that context, we might be, wanting to understand from you maybe few businesses. You could take some names also. And obviously, we can discuss from the perspective of understanding and not to be construed as any kind of advice in the listed space or unlisted space. What are the kind of businesses that you as a fund manager or Axis Asset Management within the EV space, from the large caps in the listed space or mid caps in the listed space, or maybe small caps or in the unlisted space also, if you would want to kind of discuss, so that we want to kind of understand this in terms of opening up the mindset of investors, that these are the possible opportunities as the transformation happens to EV, not just cars but batteries and many other similar things, and within that there are various businesses which are operating. So from that point of view, I want to understand this.
So yeah, Kamal. So I mean, of course, we have some constraint about talking about stocks, but from the industry side, let's talk about sub-segments, so at least it will give some more clarity. So I think in two-wheelers there is going to be a mixed picture. So two-wheelers is where there are more than 2 dozen two-wheeler new EV players have entered the industry now. It's another story that they have a know-how issue in terms of quality of the batteries, and we have seen very sad instances over the last 6 to 12 months where two EV vehicles catching fire and so on. But they will learn over the period of time. Even if there are 2, 3, 4 more players, then essentially doubles the playing field, because right now the market is essentially 4 to 5 main players that we all know about, right? Having said that, the large existing players also are going after EV in a very serious way, and there is some upside to it for a couple of different reasons. In reality, Indian two-wheeler companies have done phenomenally well as an exporter. So all the three large two-wheeler manufacturers are major exporters from India, including getting from 25 to 50% of revenue, mind you, from exports, which is very high. And they are now in the process of creating global EV products because they already have global distribution and global country presence. I was on a vacation about just before COVID in Peru, in South America, and then Brazil. And on vacation, don't we love to take the pictures? Believe it or not, I took more pictures of Indian two-wheelers and Indian three-wheelers in Peru. And as you might look in your suburb in Delhi, or the way I would look in Mumbai, a given two-wheeler, three-wheeler major company showroom there, that is what I saw in Lima and Rio respectively. A regular Indian company showroom where it was as local as any. It was a proud thing to watch. So inside of two-wheelers, we are going to see Indian companies coming up with EV products which are going to be global products because we have great distribution. In four-wheelers, it's going to be 2 to 3 years behind the two-wheelers because of complexities. And inside of four-wheelers, again, we are going to have, high-quality players. Already you saw some of the, tractor to automobile majors coming out with high-quality EVs and already getting acknowledged by the markets. So again, the net positive, it's going to be net positive for Indian automobile manufacturer. They can get their cash flows both from EVs and from ICE vehicles. Mind you, ICE vehicles are going to be around for another 20 years. You have to take two things into account. One is, what is the incremental percentage of registrations coming from EVs? Number one. Number two, of course, what is the gross stock of ICE vehicles in the country, in India? So as a percentage of gross stock, of ICE vehicle in India. The new EVs are going to be, percentage, 1-2% of now. So these companies have the last plant of Maruti that it put in Gujarat of around 10 to 11,000 crores is all EV. It's all ICE vehicle, by the way. It's not EV. And they're going to EV, come with EV later on and so on. So I'm positive about and of course, let me quickly touch upon heavy commercial vehicles and commercial vehicles. I think in this sequence of two-wheelers followed by four-wheelers, then there'll be more, EV penetration that will come through in commercial vehicles. It is going to take a bit of time, simply because the economics of the freight operator, freight owner, fleet owner needs to work out, and when that becomes sensible, only then can it come. It may take some subsidies from the government to make it cost effective, but it will happen. Bottom line is, in all the scenarios, we see the Indian auto ancillaries and Indian vehicle manufacturers to benefit from both the growth, both these growth areas.
Sure. So, we might be wanting to learn and might be wanting to sound very educated and very experienced and ultimately very wise. But the most intelligent, I would say, person in stock market is stock market itself. And, that is reflected in the fact that last 1 year, we have not seen, IT participating. We have not seen pharma participating. We have not seen financial services participating. But on the other side, what has actually participated is something like PSU banks or something like PSUs, like the ones which you mentioned are avoidable, right? So, and at the same time, defense as a sector, as a theme which nobody could ever kind of conceptualize. I have not seen any portfolios having allocations to some of these PSUs or commodity stocks or such cyclicals, but they are the ones which are participating. And there is this another, I would say, learning in equity market, which says that during falling markets, those sectors which fall less, maybe they lead the subsequent bull run. So keeping this as an understanding, obviously we understand the bigger picture. Now I'm coming to the micro picture. So while stock market does teach new learnings to even fund managers, how do you see last 1 year where index today is at all-time high, back to all-time high, but most of the mutual funds, most of the PMSs are maybe at a level where Nifty was at 17,000 or Sensex was 10% lower from these levels, because many good quality businesses, be it IEX, be it L&T Technology Services, be HDFC Bank, be it TCS, and many more names I can take, maybe Laurus Labs or Aarti Industries, Deepak Nitrite, all your sectors that you talked about, right, from there. So all those stocks are 20% lower from the all-time highs, but index is at all-time high. So
Yes.
how do you read? This is the last question, and I'm giving you full 10 minutes to answer this question, because this is one of the most important questions that investors must be having in their mind. All those investors who are already invested in various products. Over to you.
Sure. So Kamal, the trick here is, um, so first of all, let's also be clear in 3-4 sectors that you mentioned. Banking is the one, by the way, it has still done well. And it has in fact outperformed even the private sector. PSU has done fantastically well, and then so on. So that's number one. And we were happy, by the way, in our funds to kind of so that has always looked interesting to us. That's number one. Excuse me. Many of them, in my view, again, every fund house has their own outlook and their preferences. But many of the names that have outperformed in last 1 year, from ESG standpoint, I suspect many of them would have not invested into. So I'll not get into the names and the thesis there. But from various, there's the ESG angle, which let me suggest to you that 30 to 40% reason of attribution of what you just mentioned is ESG. But I will not be drawn into a deep dive conversation to that one. So that's the second part. Third is, by itself, it's not negative. Funds don't have to do lockstep with the market. It's okay to be in high quality companies, because what the reality of the high quality companies every 3 years, every 5 years, every 7 years, every 10 years is that across cycles they have repeatedly come on up. So, pardon me. And thanks for giving me slightly longer time. I did mention to you one interesting statistic, which is that 17 industries out of 61 industries that exist in India 100% of industries, one total, there are 61 as per MSCI classification. Of that, 17 industries have accounted for 75% of the stock performances, instance of stock performance. So from can you if you think of banking industry, private sector, commercial banking, or an NBFC, or a cement, or a paint, or or pharmaceutical, which has not done, I would agree, in a while now. But look at a longer period in time. The reality is, let's pick paint, and let's pick private sector commercial banking, let's pick NBFC, and let's take even automotive at the same time. In reality, one think of one or three, four, five players in each. Okay, three, four, five players in each. One or two of them have always outperformed. If not bank number one, private sector bank, then two has outperformed. If not two, then the third has done well in every 1 year cycle. Similarly, go to paint. If not the first, then second would have done well. If not second and third, first and third would have done well. And I can keep on going. This is the reality of these 7 industries. And that is continued, by the way, not that it is fundamentally changed. So what we look for, unless the industry dynamic changes, and let me give you an example. I was telling you about good industry that remains good from a shareholder standpoint, and good industry that becomes worse from the shareholder standpoint. In other words, industry becomes good from customer standpoint, but bad from shareholder standpoint, which is a great example. The best example there is telecom. Telecom between 95 to 2007, 8, 9 was a phenomenal industry. And after that, and not necessarily good for shareholder customers, by the way, great for shareholders. But come 3-4 years later, and for next 7 to 8 years, great industry for customers, one of the lowest rates on the planet when it comes to telecom tariff. Great for customers, but poor for shareholders. And again, the same thing is turning back. So that is what, to answer your question, this is what we look for. That which are the industry which is good, good for shareholders and continuing to good for shareholders, or ordinary for shareholders, but now incrementally become good for shareholders. An example of that is, by the way, auto ancillary. In my growing up years and in your growing up years, there was two of everything in India's automotive. There were two automotive manufacturers majorly. There was Hero Honda and Bajaj Auto. When it comes to commercial vehicles, there will be Ashok Leyland and Tata. When it came to passenger vehicles, it will be more like Maruti and combination of Fiat and Mercedes, if you will, and so on. When it comes to tractor, there are two players. There is Mahindra and Mahindra, and there is maybe TAFE or Escorts. But essentially, two players will have 70-80% of the market, and that created a severe problem for auto ancillary, which was one of the worst industries in India. If you go back in time, if you go back 5-6 years from 2013, 14, 15 till today, it has become one of the best industries in India in terms of shareholder return across, because now you can't think of a quality two-wheeler global manufacturer who is not present in India. There is Honda in India, there is Yamaha in India, there is KTM in India, there is Harley Davidson in India. I mean, everybody is here. There is not a car brand that you can think of which is not in India. You will have South Korean cars, you will have German cars, you will have French cars, you will have American cars. If anybody is worth his salt, the car will be sold here in India. Same also with tractors, by the way. Same also. So auto ancillary, which was selling to 2 of everybody, is actually selling to 10 of everybody. And that changes everything. So again, the example of good, ordinary becoming good. So that is what we strive for in our research. So your question, and that was actually very insightful, that fund managers, get stuck to certain aspects of index benchmark, and it turns out that benchmark behavior alters because underlying dynamic change, and sometimes the fund management industry is behind 1 or 2 steps behind and doesn't catch up. If you neutralize for ESG sector, to my mind, they are not that much behind, number one. And number two, this is part of the evolution of the story. I mean, it's part of, this is where you identify, good fund managers versus the rest. Because then many people will have to take the call, 1 year ago from today, whether should I go into PSU banks or not? Should I go into Indian defense or not? Exactly the same time right now today, we should think about whether we should get into two-wheelers or not. whether we should get into, some heavy commercial vehicles or not. Should we go into more auto ancillaries or not? Indian auto battery manufacturers or not? Should we go into housing finance companies more or not? And that can become very interesting conversation.
Sure. So in last 5 minutes, we'll take five questions
Sure.
from the audience. I have
Yeah.
just, few of them. Maybe you can keep short answers.
Sure.
So what are the top three sectors you want to bet over, say, next 3 years?
Banking, NBFCs, automotive.
What are the, so do you think, IT services has bottomed out? IT and IT services?
So it's not a yes or no question. It will depend on the quality and the nature of recession in US and Europe. Both are expected to go in recession. For recessions in the US, 90% of the time is up to 2 quarters only. Even if it happens, it's 1 2 quarter only. So it will depend on that. Though I don't see IG doing anything great because of the valuation problem. They are still richly valued versus 14 to 19 average. So they are great quality companies. They are wonderful managements, great moat, but the stock return will be there in few. But of course, it will be much lesser versus what we witnessed uh, between June of 20 to June of 22 or April of 22.
Sure.
Those, yeah.
So what is your view with regards to Fed rate hikes? Is that more or less done, or we can see more surprises?
I think Fed will continue to rise because they don't want to settle the inflation at 4% or 5%. They have to settle the inflation at 2%. So even though inflation reading is receding, they will have to continue because it needs to. They have to go to 2% because otherwise creating all kind of problems. The other story that the threat of 75 base point, all that is gone, and market kind of cheered it. More and more regional Fed presidents are talking about need to reduce the speed of growth and the extent of growth. They will grow for sure, but it is and especially now that there is concern on the recession, I don't think it is going to go severely high. But having said that, it's still going to pinch. It's going to pinch the equity valuation because high Fed rate is a PE killer. There's a direct correlation.
Right. So many of the new age businesses, which have not been profitable yet, or some of the ones which have recently become profitable, but valuations were very high, which came up with IPOs in last couple of years.
Yeah.
Is it the right time to now enter into those, or still they are kind of expensive, or you think one should be out of them?
I don't think one should be out of them for sure. At the same time, this is one company at a time phenomenon. There is nothing to group them here because all the companies are really different, serving different customer set, different spending pattern, different penetration. So some names are interesting for sure. Just that we are constrained not to talk about stocks, but I would, by the way, study them a lot. It's another story. You keep on studying every quarter when the result comes out or major event happens, and not buy. But a time will come when many of them are going to become buys.
Sure. Like we saw, specialty chemical sector generating, I think, maximum wealth in last 5 years. Any other sector which today is less known, but you think over this progression, to 5 and 6 trillion economy would actually emerge as a next wealth creating sector?
I think in autos and EVs there will be some real big surprises. We'll see some global players come from there. I think because this is the product hit phenomenon. If your product becomes hit in any of the and the ancillaries that are connected with it. And ancillaries, by the way, many of the ancillaries are doing with interesting business with India's defense sector, and there's going to be India's defense export. So there will be some unexpected players doing interesting things here.
The last question, as you mentioned, financial services as a sector will continue to dominate, the overall allocation weights in this transformation and progression also. So within financial services and banking as a sector, today we know, it is divided in maybe two parts majorly, which is private sector banks and NBFCs. But do you see some of the fintechs or AMCs or wealth management companies, becoming part of it and dominating, or maybe, becoming actually bigger players in terms of market caps?
Very difficult. See, AMC, unfortunately, everything is reduced to the pricing it can charge. It reduced to that. So the yields have been coming down every year, and regulator wants pricing to be capped and difficult to kind of. So it is not a free market. The pricing is kind of capped. It's a problem. So ROE, ROC cannot go up exponentially because it was unregulated. If it is between buyer and the seller, I can do what I want to do. But if pricing is capped, it's a different condition. Again, wealth management, because there is no entry barrier in wealth management. If you are going to charge too much, I'm going to go to the next person. If he's going to charge too much, I'm going to go to the next person. So there is no entry barrier on this. So it shouldn't be happening. If it happens, I think it will be an aberration.
I think it has been really insightful session. Thank you so much, Hitesh, for giving us your time. I think we have covered your presentation, the new age investing approach, as well as most of the questions that were there in my mind and were asked by the audience. Thank you everyone for joining us today. For more of such insightful sessions, you can log on to pmsaifworld.com. We have a plethora of articles and a lot of data points regarding valuations, earnings, liquidity, and we keep on writing those articles. And that is a content part of our business. But most important part of our business is wealth management and investment services, which is supported by content. And that is where we kind of help our clients and our investors investment services by helping them make informed investment decisions. You must look at the top 30 list of PMSs that we have been coming up every quarter based on quality, risk, and consistency analysis, which is a very objective framework. If at all any of you wants to seriously actually build wealth by investing into either PMS or AI product, you must try booking an appointment with us. We will surely share with you a lot of insightful data and information beyond which is available in the brochures of some of these PMSs, because we have deep dived them, not just on the basis of performance, but risk, quality, and many other factors. Thank you, everyone. Have a nice weekend. Thank you.
Thank you.